Happy 2024, everyone, and welcome back to our video series. My name is Tyler Johnson. I am the owner and lead financial advisor with Stillwater Financial Advisors here out of Charlotte, North Carolina. After using the last three videos to address some timely year-end topics, we are coming back to addressing different types of insurance. On December 8th, we talked about life insurance, and this week we're going to focus in on health insurance. Regardless of the source of your health insurance, the main terminology is similar. Your premium is the amount that you pay for your health coverage. With employer plans, a good portion of this is usually paid by your employer, but some of it comes out of your pocket. Your deductible is the amount you personally have to pay before your insurance starts covering a majority of your expenses through a copay. Your copay is defined in your policy and is the split of costs between you and the insurance company for different services until you've ultimately hit your out-of-pocket maximum. And then your out-of-pocket maximum is the total amount that you will have to contribute of your own money before all of your in-network services are covered. Pay attention in family plans to whether your out-of-pocket maximum is for the entire family or if there's a split between the primary insured and the others covered in the plan. Also worth noting, health insurance does reset each calendar year, and those amounts start from scratch on January 1. In 2024, if your deductible is $1,600 or more as an individual or $3,200 or more as a family, you have a high deductible health plan, and that is gives you access most likely to a health savings account, also known as an HSA. Unlike other plans, an HRA or an FSA, the money that's deposited in the HSA is yours to keep forever, and you can invest those funds for growth if you don't need them in the current year for health expenses. You get a tax deduction for the year that the money is contributed to your HSA, and tax-free growth, until you use the money, as long as you use those funds for qualified health expenses. However, a high deductible plan is still not the right fit for everyone, and your plan options and expected health needs should be reviewed alongside of a trained professional to determine the right solution for you holistically. In general, if you tend to be healthier, it may make sense to look at a higher deductible plan because it will cost you less to have the coverage, and it will give you access to an HSA account, which is an advantageous savings vehicle. If you tend to have a lot of family or personal medical expenses, you may be best served with a lower deductible plan that will start sharing your costs sooner and also have a lower out-of-pocket maximum. You should also review your plan's requirements for in-network versus out-of-network providers, which affects your coverage, prescription details, and then also copay percentages for different types of services, because all of those can be a little different plan to plan and may influence what is ultimately the right thing for you. This topic is way too complex to adequately address in 3 or 4 minutes. So if you want to talk through this in more depth and tailor your plan, I'd be happy to be a resource for you, and you can engage with me further at stillwaterfa.com or call me directly at 704-248-5553. For now, wishing you a financially prosperous new year and excited to engage with you in the days ahead. Do not forget to hit subscribe below so that you can stay up to date on new content. We'll see you next time.